Hi, hello, welcome to all of you. This is Dr. Manjunath N, Assistant Professor from Department of Commerce and Management Studies of Government First Year College, Srinivaspur. This session is particularly designed to BBA 5th semester students of Bangalore North University. In this session, we are going to deal with the subject called Investment Management. The topic for the session 40 is portfolio strategies using derivatives. Before going to discuss about portfolio strategies using derivatives, let us know which concept that we discussed in the previous class. We have discussed about portfolio strategies using derivatives as an introduction part in the previous session. The main objective of the chapter is to provide an overview of portfolio management strategies, portfolio revision, and rebalancing, and apply the various measures for evaluating a portfolio. The session outcomes of this particular 40th session is the students will be able to describe the strategies using in managing an equity. You will understand the portfolio strategies using derivatives. Portfolio typically use derivatives for three reasons. One is to reduce risk by hedging a position to gain access to managed cash flow. Here, portfolios typically use derivatives for three reasons: to reduce risk by hedging a position or exposure, to gain access or adjust exposures to specific asset classes and or factors in order to add value, and to manage cash flows. Using derivatives to reduce risk. Derivatives overlays are uses in portfolio to hedge or reduce unwanted risks. These risks are usually market risks, which refers to the sensitivity of an asset or portfolio to overall market prices movements, such as interest rates, inflation, equities, and currency. Derivatives can be used to hedge portfolios as well as individual assets. For example, say an investor owns share in ABC company, and although the investor believes in this stock in the long run, he or she is worried about short-term losses in the industry. To protect himself or herself from losses, the investor can buy a put option on the company that gives him or her the right to sell ABC at a specific price. This means that if the stock falls past that price, the losses will be offset by gains in the put options. There are two types of options. American options can be exercised at any time before the expiration date, while European options can only be exercised at the expiration date. Investors must keep in mind that every hedge has a cost, and it is the price paid to avoid uncertainty. Tail risk hedging has also evolved since the global financial crisis, with managers using hedges designed to mitigate large adverse moves in the market. Derivatives in international investing. Currency hedging is used by fund managers who invest across international markets. Currency risk is often a significant portfolio of the total risk of an international equity or fixed income portfolio. Purchasing foreign currency assets means that the investor is exposed to foreign currencies. Changes in the value of the foreign currency relative to the local currency will result in a change in the value of the asset in local terms. Often, managers will hedge currency risk at the diversified portfolio level rather than individual asset classes or securities. Some portfolios utilize a hedge ratio where a portion of the portfolio is hedged, achieving a result between that of a fully hedged portfolio and an unhedged portfolio. It should be noted that currency overlay strategies can be used to reduce currency risk as discussed, but can also be implemented to enhance returns if there is a view on the direction of currencies. A range of derivatives instruments can be used to manage international exposures, including forward contracts, options, and futures. Currency swap options called swaptions can be used to create more unique transactions. A currency swap involves exchanging interest payments and the principal of two different currencies at an agreed date for an agreed price. The buyer and seller exchange fixed or floating interest payments in their respective swapped currencies over term of the contract and the principal at the termination date. Currency hedging also involves a return that is not associated with currency or market movements. The rate differential between currencies is a source of return as an investor earns the domestic interest rate and pays the foreign rate. Historically, Australian investors have benefited from higher cash rates relative to the global rates. The chart derivatives in fixed interest portfolios. Like equities, derivatives can be used to lock in the purchase or sale price of a fixed income security or portfolio. Fixed income managers use derivatives as risk management tools to adjust exposure to interest rate, credit, and currency risk. Derivatives can be used quickly and efficiently to change market exposures without buying and selling the underlying bonds. If interest rate increases are anticipated, both bond duration can be hedged by paying a fixed rate of interest rate swaps or taking short positions in bond futures. A portfolio that is duration hedged can outperform a non-hedged strategy when interest rates rise more than that is embedded in the yield curve. Thus, investors usually use derivatives to implement tactical changes or short-term changes less than 3 months to interest rate risk in order to add value. Portfolio managers can also employ derivatives to manage exposure to credit risk. Credit default swaps, that so-called CDS, can be purchased on individual bonds or various credit indices to reduce exposure to credit risk without selling individual bond positions. Credit default swaps are considered to be insurance-like contracts which offer credit protection in the event of a default. These instruments can be used at time when the market becomes overheated. during a credit cycle. The type of instrument used depends on whether the portfolio manager would like to hedge a broad-based risk or one that is more specific. For a broad-based market risk, futures contracts or options on futures can be a good instrument. On the other hand, for specific securities, a customized instrument is needed. Gaining exposure or adding value. In addition to risk management, derivatives can also be used in portfolios to gain access to particular markets or factors quickly and inexpensively. One of the basic concepts of derivatives is that they efficiently replicate exposure to an underlying index. Thus, passive investors can also access the market through futures or swaps. Derivatives can also be used to meet asset allocation objectives rather than buying and selling physical securities to alter exposures. These can be accomplished through appropriate futures contracts at lower transaction costs. Using derivatives to speculate on market motives has often been criticized and involves risks that investors must be wary of. As equivalent market exposure can be gained with little upfront capital, derivatives are often levered instruments. For this reason, there is potential for large gain and losses. In a multi-managers environment, many managers use derivatives to achieve a desired asset allocation. For example, the bonds and equities split without disrupting the specialized underlying managers. Derivatives also allow fund managers to increase and decrease their portfolio's beta, while sector overlay can be used to increase or decrease exposure to specific sectors within a portfolio. Derivatives can also be used in hedge fund replication overlays with attempt to replicate exposures to common factors in hedge funds. Similarly, portable alpha strategies can be used to add value to a portfolio. Simply put, it involves transporting alpha to an index or market tracking return. The index exposure or return is captured through futures or swaps with little upfront capital, and the remaining cash is managed actively to generate alpha independent of the index. Managing inflow and outflows. Derivatives can also be used to manage inflows and outflows of cash in a portfolio. A large cash flow has the effect of reducing the portfolio's exposure to other assets and changes in the chosen asset allocation. A planned withdrawal will also increase cash holdings until the withdrawal occurs. Rather than sitting on cash or deploying the cash quickly into inappropriate securities, a better strategy would be to use long positions in stock index futures or index call options to gain a similar exposure quickly. This strategy is known as cash equitization. It will reduce cash drag and enable portfolio managers to maintain the overall asset allocation of the portfolio. Derivatives are critical to managing diversified portfolio, and due to their flexibility and varied applications, derivatives markets have seen rapid growth. While derivatives market have forced increased scrutiny and regulations in the recent past, derivatives have very useful applications within portfolio management and play many roles in both risk management and return creation. Dear friends, we have multiple questions to discuss in order to understand this concept with more conceptual understanding. These questions are required. The first question in multiple choice section is dash options can be exercised at any time before the expiration date, while dash options can only be exercised at the expiration date. So here we have four options. Option A, American and European. Option B, Australian, Indian. Option C, foreign, domestic. Option D, Sweden, Russian. So what could be the answer for this? The answer is option A, American. Options can be exercised at any time before the expiration date, while European options can only be exercised at the expiration date. Question number 2. A dash involves exchanging interest payments and the principal of two different currencies at an agreed date for an agreed price. What would be the answer for this question? Option A, dividend swap. Option B, interest swap. Option C, currency swap. Option D, asset swap. The answer, can anybody guess? The answer is option C, that is currency swap. Like that, we have one more question. What is CDS? Option A, merge default swaps. Option B, default swaps. Option C, debit default swaps. Option D, credit default swaps. What is your right answer for this? Yes, the answer is option D, credit default swaps. We have another question. Dash can also be used to manage inflows and outflows of cash in a portfolio. What would be the answer to fill this blank? Option A, derivatives. Option B, swaps. Option C, bonds. Option D, agreements. Can anybody guess the answer for this? The answer is option A, derivatives. Similarly, we have another question. For a dash, futures contracts or options on futures can be a good instrument. Option A, interest-based risk. Option B, broad-based market risk. Option C, market risk. Option D, security risk. What would be the answer for this particular question? The answer is option B, broad-based market risk. For a broad-based market risk, futures contracts or options on futures can be a good instrument. Like that, dear students, we have so many references and books are available on this particular topic. It is my strong advice to all of you. Please go through the references that we listed in this particular slide, and I wish you all the best and good luck for all of you for your patience listening. Thank you one and all, and thank you very much.